After working with hundreds of finance teams, I can tell you one thing with absolute certainty. Spreadsheets don't fail, but people do. And the wrong person on your finance team, they won't just mess up your books, but they can quietly kill your next deal. Look, I've seen founders loot crores in exits, not because the business was bad, but because the finance team couldn't hold it together when it really mattered. So today, I'm going to give you 5 hard-won lessons, 5 things I wish someone had told me early on. And if you're scaling your startup right now, especially if you're eyeing an exit, this might be the most important 10 minutes that you'll spend this week. Quick intro for those who don't know me. I'm Kishore Dasaka. I'm a fractional CFO and I work specifically with founders who are scaling their companies. We've helped founders navigate everything from Series A to full-blown exits, deals in the range of 2 million to 50 million in revenue. And the messy stuff that makes or breaks your exit. And a lot of what I'm going to share today, it comes from watching real deals fall apart because someone on the finance team dropped the ball. So let's get into it. So there's something that might sound sort of counterintuitive. When you're hiring your finance team, the resume matters way less than what you think. We've seen this pattern several times across our clients. A founder hires someone with a great pedigree, a Big Four background, impressive credentials, and within 6 months, the books are an absolute mess. Month-end reconciliations are always late. Month-end closes are always late. Reconciliations are piling up. And when it's time for a diligence, that is precisely when all these things blow up. The buyer's team asks for a 3-year reconciliation and your team can't produce it. Why? Because they've been kicking the can down the road for months together. And then you look at another company. They hired someone with half the credentials that this guy has. But that person treats the company's money like their own. They ask the right questions. They flag issues before they become fire. They close books like clockwork. What is the difference? Mindset. And here's the simple test that we use. Ask them what they'd do if they found a $10,000 discrepancy at 11 p.m. on a Friday. The right person says that they'd stay back and figure it out. The wrong person says they'll look at it on Monday. That tells you everything you need to know about your finance hire. You can train somebody on accounting. You can teach them Tally, QuickBooks, or NetSuite. But you can't train ownership. You can't train discipline. And you definitely can't train someone to care about your company's numbers. Now, that discipline thing, that shows up at a very specific place. And most founders completely miss it. I heard one very famous saying from Mr. T. Harvekar, how you do anything is how you do everything. So true at this stage. Now, let me tell you something that's going to sound really strange. I'd rather have a finance person who makes mistakes and tells me about them rather than having someone who stays quiet and looks like everything is fine. Because here's what happens in the real world. A good accountant catches an error. They flag it, they fix it, and they move on. That is completely normal and that is healthy. But the guy who is quiet, that is where things get really scary. We had a situation where a founder was preparing for a QFE review. Everything looked clean on paper. But the finance team hadn't been asking questions about certain related party transactions. They just booked what they were told. No pushback, no flags. And here's the worst part. The founder had absolutely no idea because nobody told him that there was a problem. He found out from the buyer in the midst of a transaction. Now think about that. Your biggest deal and you're blindsided by your own team. The acquirer's team caught it and the deal nearly fell apart. Not over a number issue, but over a trust issue. And here's the rule. If your finance team doesn't ask these questions, be worried. Because silence quite often hides more problems than mistakes made. Now, this brings up a bigger structural problem that I see founders make all the time. The next one might be the most expensive mistake on this list. This is one of the most common mistakes that I see, and it's not even close. Founders use the word CA, CFO, and controller interchangeably, as if they're all the same thing. They're not. They're not even a bit close to each other. A CA, let's understand, a CA is trained in compliance, tax, audit, statutory filings. They make sure you're legal. That is their superpower. A controller is the operational finance backbone. They own the books. They do the monthly close, the reconciliations, financial reporting, and they make sure that the numbers are right on time. A CFO, that is a completely different animal. A CFO thinks about where the business is going, cash flow forecasting, capital allocation, exit strategy, investor relations. They translate your numbers into a story that the buyers and investors want to hear. Now, here's the problem. We've seen founders put a CA in a CFO seat and wonder why their investor numbers don't make sense. Or sometimes put a CFO in a controller seat and wonder why the books are always a month behind. You've got to match the role to your real need. And that means understanding what stage your company is in. Here's the thing that catches most founders off guard. And I'm going to and I'm going to say something that might make some of you uncomfortable. And that's okay because it needs to be said. A lot of founders today are outsourcing their finance function. And honestly, in many cases, that makes absolute sense. Especially in the early stages, it is really cost effective. You get expertise on demand. But here's what you can't outsource, and that is accountability. Even the best outsourced team in the world, at the end of the day, the final responsibility sits with you, the founder. When an acquirer does diligence and finds a gap in your financials, they're not calling your outsourced accountant. They're looking at you and they're making a judgment about whether you run a tight ship. So, yes, outsource the work, but don't outsource the outcome. Review the numbers yourself, ask questions, challenge reports, because blind faith, that is not culture, that is carelessness. Here's what I tell every founder we work with. Block 1 hour every month. Sit with your finance team, go through your P&L line by line, and ask them to explain the top 3 variances from the last month. If they can't explain it, you have your red flag right there. 1 hour a month. That's all it takes to stay on top of your numbers. And that brings us to the hardest lesson of all, the one that costs founders the most money. And this one is personal, because I know how hard it is to let someone go, especially in India and especially in a small team. There is loyalty, there is history, and there's the guilt of letting somebody go. But here's what I've seen over and over again. The cost of keeping the wrong person on your finance team is always higher than the cost of replacing them. And I'm not just talking about salary, deal value that you leave on the table. Messy books lead to lower valuation. It is just that simple. Buyers discount for uncertainty and messy numbers. And messy finance teams create a lot of uncertainty. A good finance person can save you crores of rupees. They catch errors even before the auditor does. They structure your book so that they tell a clean story to the buyers. They make all your exit process 2 times faster. But a bad one, they can quietly bleed your company without you even noticing, until you're in a data room and the buyer team starts pulling all threads and suddenly everything starts unraveling. So if you're sitting there right now thinking about that one person on your team, the one that you know who isn't cutting it, trust that instinct. When in doubt, always upgrade. Because people mirror founders. If you tolerate mediocrity in your finance function, your team will tolerate that too. But if you obsess over clarity, over accuracy, or over getting right, then they will also follow you. In the world of finance, the right person can turn chaos into rhythm, and the wrong one can turn systems into chaos. The difference between the two, it usually comes down to one person making that one decision about who they trust with their numbers. Remember what I said at the start? Spreadsheets don't fail, people do. But the flip side is also true. Right people don't avoid failures. They create wins that you didn't see coming. And if you like this video, share it with another founder who may need it.